Good morning and welcome to the National Institute of Economic and Social Research. My name is Adrian Paps. I'm Deputy Director for Public Policy. And it's my great pleasure to welcome you to our economic forum, where we're going to present our UK and global economic outlooks, and that includes some regional analysis. I'm joined today on the panel by a number of colleagues who have helped prepare our outlooks together with our two macroeconomic and public policy teams. And it's a real pleasure to be able to join by you for our presentations this morning. In a little while, I will ask my colleague Corrado Macchiarelli to talk us through the global outlook, then my colleague Kima White to talk about a topical feature that we are publishing also this quarter. He will be followed by Paul Mortimer-Lee, who will talk us through the UK outlook, and then Arnab Bhattacharjee, who's going to explain our regional economic analysis. We're also joined on the panel by my colleague Janine Boshoff, who has worked on inflation and is also the main author of our regular CPI tracker. So it's a very rich program, but we will have plenty of time for your questions and comments. So do please use the QA function to ask some questions, and we'll be delighted to respond to them in the discussion. Before we start with the presentations, I will want to just make some brief opening remarks to set our work in some context. Our main finding this autumn really is that the recovery after the COVID shock is stuttering. There is a slowdown in growth, certainly in the second half of 2022, but also from 2023 onwards in the UK and beyond, growth will slow down in quite a marked way. And at the moment, even strong growth is disrupted by a number of supply chain issues, which in the UK are magnified by the uncertainty over the Brexit deal, especially in Northern Ireland. But in the UK, as indeed elsewhere, we also see growing imbalances, growing regional disparities between some of the very prosperous urban metropolitan areas, such as London and the Southeast, and other parts that are not only not catching up, but in fact falling behind on economic as well as on social measures. And what we see is that regional disparities and inequalities interact very strongly with growing poverty and indeed destitution in parts of the country, particularly the Northwest. And destitution is an extreme form of poverty with very, very low levels of income that do not cover basic necessities of life. So as always at the National Institute, we're trying to connect economic with social analysis. And this is something which we will go into some more detail in the presentations. One of the questions that arises from our analysis is whether in the UK and elsewhere, we are getting the mix right between monetary and fiscal policy. We've now argued for some time that in the UK, monetary policy has been too loose for the last decade and fiscal policy too tight. Now with COVID, fiscal policy has been loosened, and there was very welcome intervention, for instance, with the furlough scheme to prevent mass unemployment and perhaps even a descent into depression. However, with the Chancellor's new fiscal rules announced in the budget and in the spending review at the end of October, we wonder whether there isn't a risk of too fast and too strong fiscal tightening over the next few months and years, and whether that might again undercut the recovery, undercut stronger growth, more investment in national assets so that we can actually raise productivity and have higher living standards and shared prosperity. And we also have some tough questions for the Bank of England's approach to monetary policy at the moment. Now, this will all be set out in a lot more depth and detail by my colleagues. So for our presentation on the global economic outlook, I'd like now to turn to my colleague, Dr. Corrado Macchiarelli, research manager for macroeconomics, who's going to talk you through our main findings. Corrado, over to you.
Thank you, Adrian. and good morning, everyone. Thank you for joining our webinar today. So we use our global macroeconometric model, NIGEM, to run the forecast. So the global economy is still recovering from the pandemic shock, but at a slower pace than we expected 3 months ago. Our headline is that we have revised down projection for global GDP growth by about 0.1 percentage points this year. We've also revised down our outlook for next year and in 2022 to 4.3% and 3.7% respectively. The downgrade reflects development in inflation, which is growing more strongly than we expected 3 months ago, as the virus continues to crimp global economic activity and severe supply chain disruptions hold back the recovery. There is still considerable heterogeneity in the recovery across countries among advanced and emerging economies, particularly as we see faltering vaccination rates in some parts of the world. As a result of supply chain disruptions, we have revised world trade growth to 8.3% this year and 7.7% next year. Our OECD consumer price inflation is focused at 3.2% until 2022, moderating to 2.6% in 2023, remaining anyway above the rates seen before the pandemic. At the sectoral level, current procurement problems for raw materials and intermediate goods are putting the brakes on the global economy. Manufacturing in developing economies risks facing a bottleneck recession. This chart simply shows the percentage of respondents reporting supply chain disruptions in the UK by sector. Such falls are already happening in numerous industries, most notably the automotive industry, where a chip scarcity is causing a production slowdown. Supply chain disruptions arose throughout the pandemic. They peaked in early 2020 and built up again during 2021, as a more permanent reopening added to increased demand for a wide range of goods and commodities. These curtailments will feed into lower real GDP figures over the next few quarters, slowing down the economic recovery. Our inflation forecasts are higher than our pre-forecasts 3 months ago. As demand has increased and growth in some countries, especially in the US, has been rapid, commodity prices have risen sharply, and with supply chain disruptions, input and consumer prices have risen. In the US, those developments have pushed 12-month core personal consumption expenditure inflation, so-called PCE, to its highest level since 1991. All eyes are now on how persistent inflation will be and how central banks in advanced economies will react. We examine the US monthly price changes in our box A in the outlook. We follow the work of our colleague Hugh Dixon and make stylized assumptions about the future monthly price changes to derive possible path for annual inflation over the next 18 months. The first assumption is that monthly price inflation returns gradually by next June to the average level of the 5 years before the pandemic. This is shown as return to past monthly average in the figure. The second assumption is that inflation adjusts back to a higher rate, assumed to be twice that of the pre-pandemic average. Third, we assume the monthly price inflation continues at the same rate as in September. This is labeled at 0.3% a month in the figure. The implied path for year-on-year inflation in the figure show that year-on-year inflation continues strongly for the next few months, hitting 5%. Year-on-year inflation only returns to 2% at the end of next year based on this projection. If monthly inflation remains at 0.3% a month, we project year-on-year inflation will remain stubbornly close to 4%. We have downgraded our forecast for the US economy, which is now projected to grow by 5.8% this year and 3.7% next year. Supply constraints are affecting euro area growth prospects, particularly as economies most reliant on global supply chains, such as Germany, slow down. Even with this, euro area GDP growth is now focused at 4.8% this year and 4% in 2022. For this year, this is mainly driven by the expected rebound in some large euro area economies, such as France, Spain, and Italy. There is a divergence in economic growth performance within emerging economies between fast-growing China and India on the one hand, and other emerging economies whose growth patterns are more exposed to cyclical demand swings in advanced economy on the other hand. China's economic prospects have been the most promising among the big emerging market economies since the pandemic, although news from China remains mixed. India is still on track to achieve the world's fastest growth this year. we have a forecast for 9%, thanks to a still strong manufacturing and service performance. Of course, there are downside risks to the forecast for those economies. Economic activity is expected to recover its pre-COVID levels not much earlier than we envisaged in our summer forecast. In terms of regaining the pre-pandemic level of GDP, China and the US have already done so, but the euro area is not expected to regain its pre-pandemic GDP level until late 2022. For 2025, as we can see in the following slide, we project global GDP to be 2% lower than expected before the pandemic. That corresponds to a cumulative loss of GDP relative to expected by 2025 at around $25 trillion. Clearly, there are risks to consider. Risks remain skewed on the downside. Further waves, the possibility that the vaccine might not prevent against variants of the virus, the lack of progress on vaccination in many parts of the world. We have explored this in our risk scenario. We now see greater risk of higher inflation. A tightening cycle in advanced economy might create adverse financial market effects on emerging economies, especially those with high external debt and expected low growth. Leaving those economies exposed to financial market stress should investors' risk appetite reverse. The vulnerability to future negative shock is another factor. For instance, while higher public indebtedness, also private, does not constitute a problem for now, if consumer price inflation were to remain high in the future, that sustainability might be affected by higher inflation expectation and increased market rates. So I'll put the next slide with the takeaway. So for the takeaway, of course, we have this revision down, even though the economic growth is expected to continue. The most obvious sign of this dislocation is to be found in the current worrying escalation in inflation. So we expect in central bank in advanced economy to rise interest rate gradually. The biggest risks come now from COVID developing further and lack of vaccination. I'll introduce my colleague Kamar White, who's going to talk about a topical feature and analytical content of the chapter on carbon price. Thank you.
Thank you, Corrado, and thank you everyone for joining us this morning. And as Corrado says, I'll be presenting today on the topical feature that has been published in our Global Economic Outlook. This work is joint work done with my colleague Dawn Holland, where we explore the impact of a sudden large-scale sort of shock to carbon price. And of course, this sort of work has become even more interested given what's going on with COP26 at the moment. Now, carbon pricing strategies are high on the agenda of world leaders, and whether this be via carbon tax or where we have a fixed price in paid per ton greenhouse gas emissions, or whether it's a cap and trade principle, which sort of sets cap on the total amount of certain greenhouse gases that can be emitted. Now, in light of this, what we have done is we've used our in-house Niger model to highlight the macroeconomic implications from a sharp and sudden rise in the price of carbon. So specifically, what we do is we look at the impact of a $100 per ton rise in carbon price. Now, we can expect that a sharp rise in carbon price will introduce some degree of financial uncertainty. So in addition to the shock to carbon price, we also introduced a temporary rise in credit constraints to capture the heightened uncertainty and credit rationing, which is triggered by a sudden shift in asset valuations. Now, a key issue, should carbon taxes be applied globally, is of course how this will affect economic development, both within individual countries and globally. In terms of our macroeconomic impact, our analysis yields lower GDP and higher inflation in all major economies. Now we'll just go into a bit more detail in what this looks like. Now, the chart on the left illustrates the impact on private sector investment and on world trade in response to the temporary global rise in credit constraints. And as we can see, investment is expected to decline by about 5% in major economies. Trade is also expected to be impacted via global spillovers, given the high import content of investment goods in many large countries. And as we can see, world trade is expected to fall by about 1.5%. Now, in terms of the impact on fossil fuel prices, we can see from the chart on the right-hand side that post-tax fossil fuel prices rise significantly relative to renewables. So the $100 rise in carbon price will raise the price of coal by over 300% relative to renewables, whilst the price of gas and oil rather, will rise relative to renewables by about 60 to 70%. In terms of energy demand, the chart on the left shows that total energy demand will be expected to decline by roughly 15% relative to the baseline, with coal demand responsible for more than half of this decline. Now, the decline in energy demand puts downward pressure on pre-tax global fossil fuel prices, which slightly offsets the post-tax price rise. So the impact is shown on the chart on the right here. So what we can see that the global price of coal drops by about twice the decline in the price of gas. So this would reduce the profitability of producing coal and other fossil fuels for export, which accelerates the shift away from coal use. In the short term, nominal fossil fuel prices can be expected to rise by about 4% in response to the rise in global inflation and different speeds of adjustment of supply and demand in energy markets. Now, turning to the inflationary effects, the shock temporarily drives inflation higher in all countries and regions, but is more inflationary in the emerging economies than in the OECD economies. This, of course, reflects a combination of factors, including a higher energy intensity of production, especially in Russia and India, a higher reliance on coal, especially in India and China, and a strong pass-through of input prices to consumer prices and more weakly anchored inflation expectations. So a sudden rise in carbon tax of this magnitude could push inflation up by nearly 10 percentage points in Russia, but would add less than 2 percentage points to inflation in the euro area and in the UK. Finally, we show the expected impact on GDP in both the short and the long run. So we distinguish the impact attributable to the carbon tax itself from that of the credit constraint shock. And we can see the impact of the credit constraint shock shaded in black here. Now, GDP would be expected to fall by about 1 to 2% in most countries, with a more significant decline expected in the energy-intensive Russian economy, which will also suffer, of course, from terms of trade losses. Thank you. I'll now hand over to my colleague Paul, who will talk to us about the UK economic outlook.
Thank you, Kiba, and thank you to the audience for joining us. I want to talk about the UK economic outlook today. And in terms of the outline, I want to talk about 5 topics, basically. 2 are related to the economy, 2 are related to policy, and 1 is I'll end up by talking about risks. So in terms of the economy, we're going to cover growth and then inflation. So growth, in terms of growth, we think the best is behind us. We see growth slowing from nearly 7% in 2021 to under 5% next year. And half of that increase is due to base effects, to the sharp rise during 2021. If growth on a quarterly basis was 0 in every quarter of next year, we'd still have growth of 2.5%. And so you can tell that the 5% growth number rather overstates the buoyancy of growth during the year. Growth in our forecast slows down to 1.7% in 2023, and after then it slows to trend, which unfortunately is only 1.25% per year due to the UK's poor productivity performance. Some of the slowing is going forward is due to the fact that 2021 sees the largest part of the COVID bounce, but there are also effects of higher inflation and higher taxes for consumers to contend with. Consumption in 2022 is shown to rise by 8%, so that seems a very buoyant number, but again it's distorted by base effects, and consumption slows to 2.5% in 2023 and to just over 2% in the following years. So why does consumption slow so much? And the answer is there's a squeeze on earnings coming from high inflation. Real earnings rise in every year of the forecast, but there are competing forces contributing to this. On the one hand, average hours worked increase because furlough affected average hours in 2021, but not in 2022. Employment also increases in 2022. That adds to employment incomes. However, there's a squeeze on real hourly pay for many of those in work, and also on those on universal credit who suffer from lower universal credit rates as well as higher inflation. Arnab will talk more about that later. The net result is slow real income growth with consumption supported by a sharp fall in the savings ratio. So incomes are squeezed by inflation. So what happens to inflation in our forecast? Well, inflation almost everywhere globally keeps surprising on the upside, as we've seen only this week with shocking numbers in the US. That's true also in the UK. We've revised up our inflation forecasts in line with the experience abroad referred to by Corrado. It looks to us as though supply is affected much more than demand, particularly at this stage of the cycle. And so we see sharp price increases, which apply particularly to some goods and services, but of 720 different categories in the consumer's price index, over a quarter of them have increases over 4.8%. So this is not, as we saw in the past, just a couple of categories of price increases. It's pretty widespread. Going forward, we know that base effects such as VAT reductions that we saw on restaurants, for example, will soon drop out of the 12-month comparison, and energy prices are likely to rise in April. Our conclusion is that it's very difficult to avoid inflation going substantially higher, certainly to 5%, perhaps beyond in the early spring, with April being the peak month for year-on-year inflation. As you can see from the chart, inflation then starts to fall. It's very difficult to avoid inflation falling next year, given some chunky month-on-month increases this year that will fall out of the comparison. The question is, how much will inflation go down and how long will it take? Our view is, if you look at history, inflation peaks take some time to dissipate, and we view the Bank of England as too optimistic on how quickly inflation will come down. We believe that the improvement in inflation will be drawn out. Supply difficulties will ease only slowly, probably from mid-year next year, but if COVID gets worse globally, that could be prolonged. However, speed limit effects on prices, the effects that you get from very rapid growth, will diminish because growth slows down, and we expect inflation to drift lower, though we are more pessimistic than the Bank of England. What about policy? Well, looking at fiscal policy, you can see that the fiscal deficit has already come down very sharply, and that's because growth has rebounded, and the fact that we have growth at 5% in 2022 will help fiscal receipts. So the fiscal deficit will continue to improve. But the best days, again, of very rapid improvement are drawing to a close. After a falls in the fiscal deficit of 8 percentage points of GDP in 21-22 and 3 percentage points the following year, improvement thereafter is slow given a sluggish economy. Our view is that this improved profile for fiscal deficits could be smoothed, and that would be beneficial to the economy. We could have used fiscal policy to target those who are most in need and those sectors that are still suffering from the pandemic. We think there's a mismatch in the fiscal monetary policy balance in the UK. We believe there was ample room to improve the fiscal position less quickly and moving interest rates up. We think that that would have been an important step. So in terms of interest rates, Our basic judgment on interest rates, on monetary policy, is that the bank is reluctant to high rates for fear of stifling demand growth while GDP remains below the pre-COVID trend. And we've seen that by the Bank of England disappointing market expectations recently by not hiking rates. That miscommunication is a bad mistake, because when you're at such low interest rates, one of the key things, almost the only thing you have to influence the economy, is influencing expectations. And that relies much more on words than actions. So by the bank undermining its credibility about where it's been leading markets, it undermines its ability to affect the economy. We believe the bank will hike rates to 50 basis points by 2022, but will pause once inflation is past the peak, relying on running off the stock of quantitative easing to signal a tighter monetary policy stance. It will re-engage rate hikes in 2023, we believe, because the progress of inflation will lag its aspirations. If fiscal policy had been tighter, interest rates could have risen by more. Many people would think that's a bad thing. It would make their mortgages more expensive. However, it would give the Bank of England more ammunition, which it will need when the economy eventually turns down again. So the fiscal policy mismatch means that we can't support the bits of the economy we really need to do, and more worryingly, we may not be able to support the overall economy enough by being able to cut interest rates enough when the next downturn comes. In terms of risks, there are many risks and uncertainty. Our judgment is that the growth risks are skewed to the downside. Supply interruptions may mutate into demand deficiencies. Think of car component suppliers who lose orders because car manufacturers can't get sufficient microchips. A supply shock can turn into a demand shock. COVID may worsen, or the savings ratio may stay high. The savings ratio in our forecast comes down pretty sharply. In the Bank of England's forecast, it comes down even more sharply. If the savings ratio doesn't fall, we're going to get lower growth, and that would be worrying. On inflation, the risks are on the upside. People keep under forecasting inflation, and where we've done that as well. So inflation risks maybe continue to be on the upside, especially if months of sustained unusually high inflation provoke compensatory wage increases or on anchor inflation expectations. And that's why the Bank of England losing credibility about its communication is so worrying, because it increases the chances of inflation expectations becoming unanchored. So final thoughts, what's the final message? There's going to be slower growth with consumers' real incomes squeezed differentially. Some people will do better than others and some much worse, which Arnaud will come on to in a minute. Our story is also of inflation getting worse before it gets better, and the Bank of England hoping, crossing its fingers, unreasonably we believe, that inflation will quickly go away of its own accord. So growth risks are on the downside. In that context, as I and Adrian have said, we prefer more supportive fiscal policies. So with those thoughts, I'll leave you with our detailed forecast. And then I'll pass over to Arnab. Arnab, the floor's yours.
Thank you, Paul. Good morning, everyone. Thanks a lot for joining us today. The ongoing aftershocks of COVID, it will not come as a surprise to any of us, together with supply chain disruptions and uncertainty over the Brexit deal, continue to ravage through British society and economy with diverging consequences across regions and to devastating effects upon certain segments of the population. Against the backdrop of the autumn budget and spending review, together with uneven monetary, fiscal, and regional policy, as just highlighted also by Paul, we bring to you quite depressing projections of regional and distributional inequalities moving forward. So our broad message is that regional disparities are widening, notably in the Northern Ireland, and in parts of Southeast and Midlands. And the income of the poorest households is being squeezed. Universal credit uplift, which was introduced by the government last year in 2020, has now been withdrawn. Without an alternative to this, the levels of destitution will double. We argue that increases in minimum wage and changes to the taper rate are welcome, but they largely benefit a slightly different segment of the population, not the poorest. On top of this, in order to encourage regional regeneration, we need an institutional and policy framework to support local firms in creating better jobs, provide the skills that are needed, and local delivery and accountability. Now, looking at regional imbalances in output, as measured by gross value added here, all devolved nations and English regions recovered to pre-pandemic levels in 2022. This is except Scotland, which does so a bit earlier on the back of the COP26 event in the current quarter. However, the pace of recovery widely varies across the regions. Once again, along familiar and entrenched patterns, nothing new here. It has been continuing for a long time. London recovers quickest, followed by Midlands and the South and the East, while recovery in the devolved nations as well as the North of England lag behind. Very similar patterns also can be seen, patterns and trends can be seen in employment, where in general, the general pattern is broken by gradual lifting of travel restrictions and the COP26 summit. But these effects are transitory and felt most strongly in Scotland and London, whereas Northern Ireland and parts of the East Midlands and the Southeast bear the cost of uneven Brexit transitions and supply chain disruptions. The huge inter-regional disparities across the UK can perhaps best be seen in productivity, where London continues to have twice as high productivity levels as anywhere else, while the North and the Midlands, and particularly Wales, lag further behind. Now, these are broad patterns across regions. These broad regional patterns impact unevenly upon the population, as might be expected. To understand better the impact of COVID and of welfare policy responses to COVID, we conduct a counterfactual exercise, which is reported in the plot here. The distribution of expected household consumption in 22-23 in the red line is compared against what would have happened without COVID, which is the black line here. Okay, and what would have happened if the universal credit uplift would have been continued, which is in the gray line. So what do we observe? This is remarkable. As expected, COVID pushed consumption leftwards to substantially lower levels. These levels are substantially low, particularly in two segments of the population, the regions marked A and B. The A region are middle-income households who suffered a large contraction in their consumption as a result of COVID. And the region B are poor households who are pushed almost to the edge of destitution and some even to destitution. Particularly in the region B of poor households and further to the left, about half of this shortfall in consumption would have been met by continuing universal credit uplift for another year. But alas, that has been taken away, even though it would have cost the exchequer only about 5% of the benefits budget. So against that backdrop, the expectation of falling savings rate and higher consumption appears to be a bit of a pipe dream. Now, what this also does is that in the region B and further to the left, it creates huge imbalances in the distribution of destitution, which can be seen in the map, where devastating effects clearly concentrate upon certain regions, particularly in the Northwest. More detailed analysis and charts, so on and so forth, can be found in the Outlook. So please have a look at it. What we are going to do here is, well, we have discussed a little bit of welfare policy here. We are also going to discuss what might be policy options for the government in terms of regional regeneration. So first of all, and something that we, has not been talked about too much previously, we think that there is something to be done in terms of the capital markets. We have over-centralized capital markets. So we suggest creating regional and sectoral banks encouraged to lend within certain areas and sectors, and perhaps also expand the remit of the National Infrastructure Bank to a National Investment Bank. Further, on the skills mismatch, which needs to be really sorted in order to support some people back to work, and a relatively large segment of the population, we suggest building partnerships between higher education and further education institutions to foster hybrid skills, to bring them together with business, trade unions, and local government to provide more apprenticeships, and to create vocational entry opportunities to the labor market, especially where there are skills shortages. Finally, on policy design and delivery, we think the time is now right to empower local government to move in the natural direction in which the process of devolution has also taken us, to boost capacity by providing revenue streams not directly controlled by Treasury, strengthen ability to adapt to local requirements for long-term investment, again, moving towards the leveling up agenda, build up strategic capacity to link issues of infrastructure to education, housing, and training, and finally, enhance accountability to the citizens and not simply to central government. We think these are very much necessary in the political development, in the development of the political infrastructure on institutions of the country. In summary, regional disparities are widening while the poorest households risk sliding into destitution. But there are lessons to be learned both from our own national history and from international comparison to provide examples of how regional regeneration can be done in this context. We need long-term strategy at appropriate level and scale, and local and regional capacity to design and deliver on these strategies and planning exercises. Thank you very much. I hand you over to Adrian.
Thank you very much indeed, Corrado, Kemar, Paul, and Arnab for the presentations that I hope give you a very good flavor of some of the rich analysis in our quarterly outlook in autumn 2021 that we published earlier this week. We've already had some questions, and if I may, I would like to ask the two people who've already flagged some questions to ask them directly so that everyone can hear, so we can unmute you. The first question is from John Fitzgerald. Would you like to ask your question?
Very interesting paper on the carbon to global carbon.
John, forgive me, the sound is not 100% clear. Is there any way that you might be able to adjust the microphone, perhaps? I'm so sorry to interrupt.
Is this any better?
It's a bit better, yes, thank you.
Yeah, my question is on the carbon tax paper, which I found very interesting. There's another paper by Jean-Pierre Ferry, the Computer Institute, where he models the impact of the world tackling climate change, which will raise investment by 2 to 3% points worldwide in the latter half of the decade. And that, for given savings, will put upward pressure on the interest rate. Have you considered that issue? Because I think the nightmare model will be that the way to through this properly.
Thank you, John. I will just read out your question just in case people weren't able to quite catch what you said due to the ever so slight technical problems with the microphone. So John, in the written question, said, in the Peterson paper, the French economist Pisani-Ferry considers the effects of the world effectively tackling climate change. That would involve a 2 to 3% of GDP increase in investment worldwide. The increased investment for given savings could result in high interest rates as resources are reallocated from other uses to tackle climate change. How would this play out if it was included into our simulation? So may I turn to Kemar for that question by John? And again, my thanks to John for the first question.
Yes, thank you, Adrian, and thanks, John, for this very interesting question. Just as a first response, I have to say first, in the scenario that we ran, we introduced no explicit assumption on how the carbon price might incentivize investment in sort of energy efficiency gains or renewable energy research, for example, both of which, of course, will have the potential to partially offset the modeled decline in effective energy. Also, I'm not familiar with the Peterson paper, but I'm not sure what sort of policy they applied in their analysis, and also whether they introduced any sort of credit constraints similar to what we have introduced in this scenario, where we had risk premium being affected, which of course will have, at least in the immediate term, a stifling of private investment. But yeah, I do think it's an interesting point in terms of the trade-off that you see here with investment with the high interest rate as a result of savings. So I do think it's something to consider. But in this instance, we haven't made that sort of explicit assumption in this scenario. I think Paul, my colleague Paul, said he might want to chip in on this as well.
Yeah, I mean, there are only so many resources. If we want to improve the climate, we have to invest more, which means we have to reduce our use of resources today to improve the climate tomorrow. And so that's unavoidable. And so if we're going to spend more on investment, we have to spend less on other things, other forms of investment, non-climate, and on consumption. And so interest rates will be higher. And of course, as we see with Greta Thunberg, there's an intergenerational competition here. The current generation will pay and future generations will benefit. So there's a conflict of interest. People will be dead well before investment in climate pays off, maybe reluctant to suffer lower consumption today. On the other hand, younger people will benefit much more and may not be working at the moment, will not pay anything. And so there's the political economy is very difficult, I think. And that's one of the reasons why we haven't made much progress. But if we're going to improve the climate, we have to invest and we have to spend less on something else. It's unavoidable.
Thank you, Kemar and Paul, very much indeed. I will also bring in Corrado if he wants to say something just in a global context about, what that might mean in terms of investments and savings, since we've got so many global dynamics playing into this as well. So Corrado.
Thank you, Adrian. I mean, I, of course, echo what my colleagues have said. I mean, clearly we haven't done this simulation specifically because we focus more on the tax side. But I mean, in my mind, what the paper by Pisani-Ferry suggests seems likely over the medium long term, particularly as green and digital investments will be directed towards industry that are typically recognized to have higher economic multipliers and implications on long-term economic growth. However, of course, it's very difficult to generalize, and I think the return on this type of investment and impact on output will be a combination of factors such as the economic structure, the instruments used, and the policy assumptions, and also the way in which, in a sense, the sort of expectations will be changed by these policies. But all in all, yeah, I think it's a short answer is that it seems likely that, of course, that will have sort of an increase in interest rate for a given level of saving if we increase investment, and particularly we direct this investment towards industry that are recognized to have higher multipliers.
Thank you, Corrado, very much. Our second question this morning is from Yvonne Esterhazy. So may I ask Yvonne to pose a question to the panel?
Hello, good morning. Thanks for taking my question. A question for Paul Mortimer-Lee, if I may, about the UK labour market. Very tight at the moment, and I was just wondering if you could elaborate, please. How long do you expect this to go on, and what consequences will it have for UK government policy? Will it have to change its migration visa policies, and will it have to reverse parts of Brexit possibly? We've already seen short-term visas for lorry drivers, butchers, and so on. So.
Thanks, Yvonne. It's a great question. Thanks for asking it. In terms of our forecast, we have unemployment in 2022, basically about 4.5%. And then drifting low to about 4.25%. So the labour market does stay tight in aggregate. And I think there are a number of reasons for that. One is that there's less immigration from Europe following Brexit. The second is that in our forecast, COVID doesn't go away totally. And so the fact, while COVID is endemic, if you like, then it will continue to have an effect on labour supply. Why? Because vulnerable people may not want to participate in the labour market, or people with vulnerable members in their family. If I looked at recent figures of younger school-aged children, I reckon there was about 400,000 sick at the moment. Well, one of the parents, and the burden will largely fall on women, is going to have to be at home, not at work. And if you've got kids, it may not just be when the kids are actually sick. You may think at some stage the kid's going to become sick. I won't look for a job at the moment because I don't want to be off sick going forward. So I think that is another permanent or semi-permanent reduction in the labour force. The labour supply situation is very uneven, as we've seen, particularly acute in trucking, but also in other areas. If you look at the US, for example, you see that wages in restaurants and other face-to-face occupations have gone up relative to the rest. Why? People don't want to work in situations where they're likely to catch COVID. And so there will be a reduction in labour supply to particular occupations. We've seen the economy shift away from services and towards goods. We don't necessarily have the skills to produce those goods. There's a very big skills mismatch in the country that I think the government could do more to help meet. Maybe Arnav will say a little bit more on that. In terms of Brexit, yeah, there are shortages in particular sectors, and there are pressures, particularly from firms, to allow more immigration from the EU. This was always inevitable. If you look at the UK relative to source countries in Eastern Europe, the UK is relatively rich in capital and poor in unskilled labour. So we'll tend to import we did tend to import unskilled labour. That would drive down the reward to labour overall relative to capital, relative to firms, and it would drive down particularly the relative returns of low-skilled labour. That's why we got Brexit votes in working class constituencies. People understood the Stolper-Samuelson theorem very well. And so what we're seeing now is the shortages in those areas. Those relative wages are being bid up, and that hurts consumers of those goods and services, such as the middle classes in the southeast, and it hurts firms. It's a competition. There's a conflict of interest between different sectors of society. So which section of the society does government want to pander to? And clearly, they want to please the people in the red wall seats. They want to keep unskilled labour in relatively short supply. So they may allow a temporary immigration, as we've seen for truckers, but I doubt very much whether it's in their political interest to have a permanent reduction, because this, to be honest, is exactly what the people in red wall seats voted for when they voted for Brexit.
Paul, thank you very much. You've touched on both the national and the sectoral picture. I'd like to bring in briefly Arnab on the regional employment picture and regional labour markets before then turning to our next question. So Arnab, may I give you the floor?
Thank you, Adrian, and thank you, Yvonne. Brilliant question. So let me divide my answer up into two bits. Before going to the regional, let me also talk a little bit of the cross-sectional. Part of this is reported in the current outlook, but even more details are found in the previous outlook, where we looked at the implications specifically across gender, ethnicity, and different kinds of household compositions in unemployment, both in unemployment and in inactivity rates. And what we found there was that the impacts disproportionately fall upon women, but particularly upon young people in terms of unemployment. And who are going out of the labor force, these are slightly older people, and both of those are, the dynamics here is actually quite critical. The problem in a way is not so much in London, where there is already low inactivity rates. There's higher unemployment, but on the base of a lower inactivity rate. But in other regions of the UK, the inactivity rate is very high and rising. And that is where much of these problems come in. In terms of employment, what we see across the regions is that, well, there is a temporary respite, particularly for Scotland and London, from the lifting of the travel restrictions and the COP26 event. But the gains of this are not being sustained, at least insofar as our projections go, because there is no long-term skills and jobs policy to create appropriate, good, green, and globally relevant jobs for the folk who are seeking to work. And that is a structural adjustment which is needed to be done. That is where institutions need to support people to get back to work. And that is not coming in. So these gains are not sustained. Employment in Wales as well has been relatively stable, but this is in largely very low productivity areas, which also are suffering because of the Brexit uncertainties and supply chain disruptions related to that. So I think it is a complex picture where one needs careful thinking about labor policy together with regional regeneration policy to try and move towards the future. Thank you.
Thank you very much indeed for those insights. We have another question from Alan Bridal. May we unmute Alan to ask his question to the panel? Thank you. So I think Alan is still on mute. Can we give him the floor, please? I'm not sure, perhaps technology is temporarily failing us. So let me read Alan's question. Levels of business and personal insolvency continue to be remarkably low given the scale of the crisis. Are we set for a period of catch-up in the data? What has been the early experience of COVID loan repayment? Question from Alan. I turn to Paul and perhaps also to Corrado for some thoughts on that. Paul.
Thank you. Yeah, it's a great question. It's something we drew attention to in the analysis of the furlough scheme. It seemed to me that maybe during furlough, there were some companies who would otherwise have gone bust, who were being kept going by the subsidy from the government. They were hoping for resurrection, for the resurrection trade, that things would get better, and the cash flow enabled that to happen. Those companies will, given that furloughs ended, will now starting to be running into problems. It may be that it will take some time for that to come to the crunch because their stock of liquid assets won't have been depleted. The other reason we've not seen so many corporate bankruptcies is the behavior of the banks. So if you look at a typical cycle, banks tend to put companies into insolvency when the cycle gets better. Why is that? The answer is, one, the corporates may improve, their financial position may improve. The second one is that if banks put corporates into insolvency, eventually they seize their assets. In the midst of a downturn, those assets are worth very little. The banks don't want to take on assets when they're not worth much. When the upturn comes, the asset value increases, and the banks say, oh, now it's time to put the corporate into insolvency. Now it's time to take their assets because we can actually sell them. They don't want a lot of non-performing loans or assets on their books eating up capital. In terms of the COVID loan repayment, I don't know what the experience has been there, but overall, I do expect insolvencies will pick up, particularly when some sectors are still very badly affected. It is surprising, as Alan, as you drew attention to, that we haven't seen more bankruptcies on a corporate level. In terms of individuals, we have seen an improvement in the savings, the stock of savings. Many people cut down on their spending, so that may help them. And it may, the increase in the universal credit now gone may have helped poorer households during the past period. Again, that's changed. So those households will be running into more difficulties as we go forward. So things will get worse, I think, on this front.
Thank you, Paul. And that is a perfect segue to a question I would like to put to Janine, which is, inflation, of course, is in the news all the time. Paul mentioned, the very worrying numbers coming out of the US earlier this week. So, Janine, are we perhaps even underestimating the inflationary pressures building up, not least because of second round effects and changes in expectations?
Thank you, Adrian. I think that's a very astute observation. I think something we haven't really discussed is that the average consumer in the UK is facing quite choppy waters at the moment. Inflation's already high, and we have certain factors that are now coming through, such as the reversal of the VAT hikes in 2020. First VAT hike would have come in October, the next one in April. We also know about the Ofgem energy price cap is changing. So what makes it very uncertain, very uneven in the next few months is that we've got sort of competing drivers of inflation going forward. So at the moment, our forecast is for a peak of inflation at about 5%, but this is obviously, there are risks to the upside in terms of, yes, the COVID, if it disrupts manufacturing further, if we suffer more supply side constraints, and then we need to still understand how these VAT hikes and the energy price caps translate, or how, to what extent the pass-through moves to consumer prices. So yes, 5%, and I would say 5% optimistically in April 2022.
Janine, thank you very much indeed. And this is clearly very much a moving picture, and there will be more work from NISA on CPI over the coming weeks and months, and no doubt much more in the winter outlook. We have a question from Alex Jessed, which I will quickly read out, and then I'll ask my colleague Corrado to respond. Alex writes this: with the most recent US stimulus package being passed, Larry Summers has predicted that the stimulus package could be too powerful. With the US constantly issuing stimulus packages, to what extent do you think, to what extent does NISA think, the US pursuing their domestic agenda will have an impact on the global economy? Corrado, for that question, please.
Yes, thank you very much for the question indeed. I mean, we have written an analysis a couple of rounds ago on the American Rescue Plan, and that has been major change for our forecast. It was an unprecedented $1.9 trillion boost, which was about 9% of GDP. So, because of course the US is one of the big two economies, this is always going to have a substantial global effect. The current focus does not include the infrastructure plan, if that's what you're asking, but by the time that we include the American Rescue Plan, the Biden stimulus, of course, that had an important effect on US GDP growth, clearly, but also a major contribution to our global growth, which at the time we estimated to be around 1 percentage point. The analysis, of course, was behind the change was presented in this NIGEM topical feature. The other aspect that we considered was not only on the fiscal side, but also whether indeed that fiscal stimulus would have led to an overheating of the U.S. economy, hence prompting an earlier than thought monetary policy tightening in the U.S. And also there, we done some analysis again in the context of the American Rescue Plan. And of course, that the end of the U.S. ultra commodity monetary policy could equally lead to some concern, particularly for emerging currencies to experience a depreciation against a stronger dollar, but also the fact that some emerging economies might be have incentive to increase the interest rate to limit any adverse effect on the foreign exchange rate movement. We've previously shown using NIGEM that such financial spillovers in case of an unanticipated tightening in the US, which will be more volatile in the short term, could impact countries with higher risk premium and countries that are lower risk rated. But of course, as we said, by the very nature of NIGEM, the US would, any US policy would clearly have an impact on the global economy. And I don't know if Paul wants to add something.
Yeah, thank you, Corrado. Great answer to a good question. I think the unknown at this stage is whether we're experiencing a change in policy and inflation regime. So it's quite clear that the global financial crisis changed the global inflation regime. And particularly in Europe, where the advent of another crisis, the euro crisis on top of the GFC, moved Europe into a very low inflation equilibrium. And we know that in the late 60s, early 70s, there was a shift in policy regime toward an inflation environment to a high inflation environment. Is that happening now? I'm really not sure. I think my own view is there's quite a big danger of that. Why? Because of policy. What we saw in the late 60s that we had expansive US fiscal policy, the Vietnam War and Johnson's Great Society program. And we had a slack Fed that was pursuing a 4% unemployment target. Now in the US, we've got slack fiscal policy with Biden basically trying to buy votes to get reelected. And we've got a soft Fed and we've got a 4% unemployment target. And furthermore, a target for the Fed to keep the expansion going until the most disadvantaged groups are pulled into the labor market. And that happens late in the cycle. And the danger is because we've got an inflationary shock and the Fed's concentrated on non-inflationary objectives, it will allow inflation to pick up. Now, that's not our forecast. It's not our forecast that we move to a new higher inflationary regime. But if we have another shock now, another inflationary shock now, we're done. We will move to a higher inflationary regime because policy will not respond. And if inflation does not go, I think, below 3 as we come down in 2022 and 23, and we get another inflationary shock, that will be it. You'll be locked into a new regime. So, we saw this in Japan on the way down. It's not the first shock that puts you in a new regime. It's the second one when the effects of the first shock haven't dissipated. So we're pretty vulnerable, I think, to a shifted regime.
sorry, I better unmute myself. Thank you very much, Paul, and indeed also Corrado, Kemar, Arnab, and Janine for all the presentations, but also the responses to the excellent questions we've had. We're so delighted that you were able to join us here this morning. It is now the afternoon. We're well into, the lunch break. And as someone once said at a conference, lunch is a human right, and we certainly don't want to stand between you and your much deserved lunch break. But thank you so much for your contribution this morning, for your ongoing interest in our work, for your support. Myself and my colleagues, we are at your disposal if you want to follow up by email or in a phone conversation with some more questions. Please don't hesitate to get in touch via our fantastic external affairs team led by Neil Lakeland, who have put on this event. My thanks to them. Again, to you, I wish you a very good afternoon and indeed a very good weekend when it comes. Thank you very much indeed. See you soon.